Well, yesterday I put out an offer in my video to review the reality of the coming collapse of the United States and why, I and I'm sure many other people expect that to be coming here in the next few years. And I was asked to go over both the details behind the economic collapse and sort of what will happen after the collapse. So I'm going to make this a two-day thing. The first part today will be just on well, I guess the economy and also politics somewhat, but the initial collapse, and then what will spring up from that, I will go into tomorrow. And so, to understand the economic situation in the United States, it would be helpful if you had a good foundation in economics. If you read, there are a few books that are very good. Maybe Principles of Economics by Carl Menger. The Mises Institute put out a good anthology of the work of Ludwig von Mises called The Mises Reader. That's also a good place to start. And if you have a good understanding of what a healthy functioning economy looks like, you will very quickly, once you look under the hood of the U.S. economy, understand why we're in a very, very bad position, even though people in, many people in the country, feel like they're doing great, like they're doing better than ever. This was true, even before the virus and all that last year. That's not where the problem started. I mean, back when Trump was, trumpeting that, oh my gosh, we have the greatest economy in American history, we were in, very, very bad, dire straits, which we have been for a long time. The situation has continually gotten worse over the last 40 years. And so the key thing to understand in all this is the credit markets. It's interest rates. It's debt. Debt is an instrument that has been used and abused by governments and central banks to create a short-term illusion of prosperity. What the central banks do is they inject money into the credit markets so that there is more money to be loaned out to businesses, to governments, and to individuals, so that people can borrow more money, they can spend lots more money, they can invest and grow their business, and for a time, it feels like, gee, we're all so much richer. But the problem with that is that they're being made richer by money that is just being printed by the central bank. And in printing money, central banks do not create wealth, they merely redistribute it, because they're not creating new wealth when you create money, because money doesn't represent wealth. What money is a claim to wealth. And so what the Fed does when they print money is they are creating new claims, they're creating more claims to wealth in this country, and they're doling it out to people through the banks. And then those banks choose to lend it out to whoever applies for a loan. And this allows the banks, the financial system, to lend money out, not just to more people, not just lend out more money than they otherwise would, but they can lend out money to people that they otherwise would not have lended that money to, because when money is more scarce, you have to be more careful with it. When you have more money in the bank, and the bank has all this money sitting on their balance sheet that they want to loan out and make interest on, then they're going to be willing to take a little higher risk, because they want to make sure that they completely lend out everything they can, so that they're making as much return on their investment, or so that they're making as much interest as possible. And so this is where the central bank and regular bank created artificial economic boom comes from. For a few years, the central bank is able to prop up a bunch of businesses that otherwise would have never been created or would have failed a long time ago, until the point to where the Fed is printing so much money to prop things up that they decide, oh gee, we better put the brakes on, as the Keynesians would say, and stop printing so much money, because we don't want inflation to get out of control. Because when you are printing money and injecting it into the economy, people spend that money, and that creates inflation. And so then what the central bank would do is they'd pull back, they'd raise interest rates, and all of those people who otherwise would not have gotten a loan, who shouldn't have had a loan, these zombie companies, these people with subpar business models who cannot actually make a whole lot of money on their own, they all go bust. And it's really unfair and brutal if you're not expecting it, because the central banks and the whole financial system plays this sort of game. I guess it's sort of like a mousetrap. They set this cheese out on the trap, and everyone rushes to get the cheese. And then, when it at the end of the business cycle, when it comes and snaps and smacks you, they go, "Aw shucks, tough luck." So that's the way the game was typically played. Well, in the last 40 years, the Fed has decided that they don't really need, at the end of the cycle, to pull back so much. The Fed has never completely taken all that new money that they created during the bubble off the table. What the Fed has done, if you look at a chart of interest rates in this country, they peaked back in 1981, I believe it was, sometime in the 80s. And ever since then, they have been on a steady decline. So every time that the Fed at the end of a business cycle has jacked up interest rates, they didn't jack them back up as high as they were at the start of that cycle. And so the Fed can't just play the game, they're not playing the same old game of, okay, you step on the gas, you go 0 to 60, and then you slam on the brakes and you go back to 0 miles an hour, and then you slam on the gas, you go back to 60 miles an hour, and then you slam on the brakes, you go back to 0. What's happening is the Fed is stepping on the gas. They're going to 60, then they're slamming on the brakes, going back down to 30, and then they hit the gas again, go up to 90, slam on the brakes, they're back down at 60, and they've been doing this for 40 years. And so what that means is that the economy has become increasingly more and more dependent on central bank created fake money. A greater and greater share of our economy only has any livelihood because of the Fed. The Fed is not just propping up a few marginal businesses to make the economy seem somewhat more productive than it actually is. The Fed is propping up, at this point, the entire economy. And it has become clear that when we finally do have a pullback, and everything that the Fed has built finally crumbles away, as it normally would at the end of a central bank bubble, we're going to crash much harder and much faster than we ever have before. And the reason for this is that we're sitting on not a 10-year economic bubble. It's not a 5 to 10 year bubble, which normally is what you have with central banks. They blow a little bubble, then it pops, and then they let it deflate, and then they blow another bubble. Now, what our Fed in this country has been doing is every time a bubble pops, they slap a patch on that bubble, and then they blow the bubble up again bigger. And the bubble every time is getting thinner and thinner, easier and easier to prick, to the point where the 2008 bubble that popped just because the Fed raised interest rates up to 5%, which historically is a pretty low rate of interest. But there were so many businesses in this economy that could not survive under anywhere near normal conditions. They could only survive in this absolutely ridiculous low interest rate environment that the Fed had to jack interest rates back down to 0. And the Fed, over the last few years, the first 2 years of the Trump administration essentially, tried to raise interest rates somewhere up to like 2%, and they failed to do that. That's when the bubble, was first pricked and the air started coming out, and the Fed said, "Oh, no, we didn't mean to," and they slapped a patch on there called QE Infinity, which I won't get into that today, but that was a couple of years ago, and they jacked interest rates back down to 0. So the Fed is trapped. There's nowhere they can go from here. They learned from Europe that negative interest rates don't do anything, and I won't get into that today. But it should be pretty obvious that the rate of interest is a positive number. If you have it going negative, that doesn't make any economic sense. You're not gonna, you can't do much with negative interest rates. So the Fed knows that they're stuck at the 0 lower bound now, and so there's not really much more liquidity that they can pump into this system. Which is why people, generally speaking, the phrase now is that we've moved from a Fed put to a government put, to where now the Fed on its own is unable to prop up the bubble, and the government has had to step in and do it through through these big stimulus bills, which are just handouts to corporate America and such, and to Wall Street. But of course, who's financing the stimulus bills? It's the Fed. because the Fed fixes the rate of interest on government debt as well, and make sure that when the federal government wants to issue, trillions and trillions of dollars in debt, that the Fed will just buy it up, so that the interest rates for the government doesn't shoot up. So then at this point, what can prick the bubble? You've got the central bank and the federal government all in on trying to prop up the current economic bubble, because they know that they can't let it pop, because that would be, apocalyptic. So what do they have to worry about? And the answer is, again, rising interest rates, because the Fed does not have total absolute authority over interest rates. Even if the Fed decides, oh, we're going to try and print money to push down interest rates, that's still a market price. The reason why interest rates are so low is because the Fed is increasing the supply of loanable funds. But there is something on top of inflation, on top of the interest rate, known as the inflation premium. And the way that works is that whatever the interest rate is set by the supply and demand of money in the financial markets, you take that price and you have to add on whatever the rate of inflation is. So if the rate of inflation is 2% and your interest rates are at 3%, well, then really what you have is a 1% real interest rate, and 2% of that 3% is an inflation premium. So if inflation rises, the rate of interest is going to rise whether the Fed wants it to or not. And if the rate of interest rises, our entire economic house of cards comes crashing down, because it's all built on people constantly increasing their debt, borrowing more and more money, and refinancing their old debt at lower and lower interest rates. That's the only reason why we're able to continually expand the amount of debt in this country. So, for example, the reason why housing prices can keep going up and up and up is because as interest rates fall, people, even if they're making the same amount of money, can qualify for a loan to borrow more money. Corporations are able to borrow money to buy back their own stock, thus driving the price of stocks higher. When you're making 0% interest on your money in the bank, no one is incentivized to save any of their money, and instead they decide to spend their entire paycheck at the end of the week. All of these things are side effects of Fed policy that create the illusion of economic prosperity. Now, if interest rates rise because of the inflation premium going up, and I'll get to inflation in a second and how that'll occur, what will you see happen? Well, all of a sudden, corporate America will no longer be able to continue refinancing their debt, which is what corporate America does. They're very heavily indebted. There are a whole slew of companies that will go bankrupt instantly if interest rates rise, because the only way that they're able to exist at this point is that they have all this debt that they continually roll over, and they're only making the interest payments, but the interest payments are so small that they're able to hang on a little longer. Next, you'll have people, all of a sudden, if interest rates go up, people will not be able to afford to buy a home, and if nobody's able to buy a home because they can't qualify for a mortgage, to borrow enough money to buy a $350,000 house, they can only qualify now, because interest rates went up, they can only qualify with their level of income to buy a $150,000 house. Well, then the demand for all those houses will evaporate, and housing prices will necessarily collapse. Same story for the stock market, because of what I was saying earlier. If all of a sudden the borrowing cost for all these firms goes through the roof, then they're not going to be making as much money. Their stock is not going to be worth as much. At least in the traditional sense of the value of a stock being a discounted the discounted value of future cash flows, which by all standard valuation metrics the stock market is way overextended anyway, because we're at, as I've pointed out many times, almost 200% market cap to GDP, meaning the value of the stock market is like almost double GDP. Typically, the value of the stock market is somewhere between 50 and 75%. That's the normal level. So in other words, even if the stock market was cut in half, it would still be overvalued. When you consider all these things, you realize just how fragile things are right now, and just how bad things will get when the current state of affairs, which really reads like a fairy tale, inevitably ends. And so, as I alluded to earlier, our current fairy tale economic order will collapse when either the central bank decides to raise interest rates. Hint, hint, they're not going to do that. Or second, rising inflation pushes up interest rates. And people have joked for years that about how the Fed measures inflation and how nonsensical it is, and how they they hide things, and they have these ridiculous standards called like hedonics and things that allow them to mask inflation. And I don't want to get into any of that today. That's a whole another rabbit hole, inflation metrics. But because the fact of the matter is that no matter what the official inflation figure is, if it's high, you can feel that. And generally speaking, even though inflation is higher than the Fed says it is, we are clearly not to the point to where consumer prices are inflating at nearly as high of a rate as asset prices like real estate, bonds, and stocks. Because make no mistake, what you see with housing prices is not sort of real free market appreciation. It is the Fed inflating the price of housing, just like they did back in the 2000s. The same thing with stocks. As I said, it's not normal for stocks to be almost 200% the value of GDP. So these assets, this has been the great magic trick of the Fed. They've been able to heavily inflate assets while only moderately inflating consumer prices. So that if you're someone who owns assets, sure, everything you buy at the grocery store has been getting more and more expensive, but the value of your assets has been going up so much faster that you still feel richer. Now, if you're an ordinary, lower middle class to lower class person in this country, and you don't own any assets, you rent your house, you don't have any stocks, you work a normal job where you don't have, well, I guess a lot of normal jobs have 401ks, but you work a job where you don't have a 401k, let's say you're a contractor or something, you have felt no appreciation from all of these rising asset prices. And if you look at the data, it's richer people who own all the stocks. Poorer people generally don't own any stocks, and they don't own their own home. And so this brings us to the current debate over the stimulus payments. And again, stimulus is a phony Keynesian term, but that's the word that we're using, so that's what I'll call them. But they're not stimulating anything. Just keep that in mind. People who own assets don't need these payments, because people who own assets are doing pretty good, because their assets are still rising, even with the whole Wu-flu pandemic situation. The Fed has made sure that asset prices have continued to skyrocket. And so your net worth is doing pretty good, even if, I guess that's not necessarily something that you've been able to generate income from. If you own a house and the value of the house has gone up, sure, you're richer, but, you still might be short of cash. But anyway, the people who are really hurting right now are the people who own no assets. And if they don't own assets, then asset price inflation is not going to make them richer. Because remember, when you have inflation, all you're doing is you're redistributing the claims to wealth in the country. And so by injecting money into the asset market, by printing money and driving up asset prices, all you're doing is you're redistributing wealth from people who don't own assets to people who do own assets. You're making asset holders relatively wealthier when compared to people who own nothing. But if you really do want to help out those people who own nothing, what can you do other than just send them cash? Just send them money to go out and spend on things that they need, like on new tires or new shoes or food. Well, that's when you finally will start to see consumer price inflation. The reason why we haven't seen as nearly as much consumer price inflation as we've seen asset price inflation is that people have not been taking all these people who own assets have not been taking all this money that the Fed has essentially been handing them, and then taking that and going to Walmart and going on shopping sprees. If everyone took, essentially every penny that they've made in the stock market on account of Fed inflation, well then yeah, we would have very high consumer prices. But people are not doing that. People are hanging on to it. They're keeping, they're keeping ownership of their stocks. They're not just cashing out and taking money out of that. But when the Fed starts cutting checks to people to just go out and spend on consumer goods, just like they've cut checks to the banks to go out and spend on assets, well, then obviously you're going to get consumer price inflation. And that's when your inflation premium on your rates of interest will start to tick up. And so the irony here is that these stimulus payments, because they're going to everybody and not just a select few, that's what will cause general inflation. Because if when you're creating money, it's only going to have any sort of net impact on the economy if you're handing it out in an unequal way. But if you print a bunch of money and equally hand it out to everybody, it has no net effect. It only will drive up prices. It does nothing to otherwise affect the behavior or the relative standing of different members of society. If everyone is handed a $1,400 check, the poor are now just as poor relative to everyone else in society as they were before. It's just that now everyone has $1,400 more dollars, added to their net worth. And so that's why we're right now dangling on the precipice of an economic collapse. We're just waiting for the final nail in the coffin. We're just waiting for that consumer price inflation to kick off. And it might not come as a result of this stimulus bill or the next one, but it's very clear that the economy is being propped up now by these stimulus bills. And just as the Fed has the Fed during their put continually had to increase it, make it more and more money that they were pumping into the economy to keep things higher. And then now we're to the point, as I said, that the Fed can't, no matter how much money the Fed pumps in, they can't do anything, and so the government has to do it. Well, the government, too, will have to continually pump in more and more money, because obviously $1,400 is not going to help anybody, get out of a rut. And so as the government progresses down the road here, and they keep pumping in more and more money, then you're going to, at some point, start seeing that consumer price inflation. I mean, they're handing money to consumers. There's no way that doesn't create inflation. It was very different back in 2008 when the Fed printed a bunch of money and understood we can't give this to the people because that'll create inflation. We need to just give it to our banker buddies because we know that they will just sit on the money and not spend it into the economy. That's why you had this massive spike in money creation as a result of the last financial collapse, and it all went to bank bailouts. So I guess that's a decent enough summary of where we are right now economically. Tomorrow I will get into what the implications of that collapse will be politically, and what that will mean for the United States. So stay tuned for that. Hopefully this video will be up on BitChute, because I've had a horrible luck with BitChute the last few weeks. It has not been working very well. I have not, it looks like I'm not uploading every day, even though I am. There's just a bunch of videos that are stuck processing. But hopefully those of you on BitChute will see this too. And with that said, if you get anything of value out of this video, I'd appreciate you clicking that like button and sharing this video. And if you haven't already, please do subscribe, because I upload every day and I'd hate to have you miss one. So I'll see you folks back here tomorrow.